Welcome to the Brand with Aggregator podcast today. I'm very happy to have you all here. This is normally hosted by Heimak, the CEO of Evaguru, but unfortunately today he had a sports injury, so he had to go into surgery very rapidly. So we are now with Melissa Simmons, the head of marketing today, which joined us in the place of Hai. And we have Chris Shipferling from Global Wide Advisors, the managing partner director. Correct, director, yeah, Chris?
Managing partner, director, janitor, you can call me whatever you need. It all around here.
Okay, sounds perfect. Sounds perfect. Yeah. And we are here to talk about the aggregator situation at the moment. And let's dive right in because we don't want to make this too long. We want to make it quick and very informative for our listeners. Recently, there have been a step down from the Thrasio CEO, and there have been some delays in what they really have planned and everything. And I wanted to ask you, Chris, about it. What do you think about it, or what is your view about all this situation at the moment?
Yeah, it's a good question. Highly germane to what's going on in the market. Look, I think if we to give good context, I think you have to back things up just a little bit and try and understand where the model kind of originated from, right? So the whole idea in Thras really was they're considered probably first mover advantage, but prior to that, of course, was 101 commerce, right? Remember those guys who came up on the scene and really they were the original, we're going to buy a bunch of Amazon businesses. And of course, unfortunately, that led to failure. And then I believe it was sold off, and Goja is really running most or some of those brands currently. So really Thras came in and the idea was we're going to buy these assets, this immature, extremely immature market, and we're going to buy these assets for very, very, very cheap. Right. So our return on invested capital is going to be extremely high once we run it through our roll up. Right. So like the finance term is roll up versus aggregator, but it's a roll up strategy, which, by the way, nothing is new under the sun. This has been done in a lot of different mature markets. This is typically the first thing that happens because those models need to get assets for cheap. That's what they have to do. So the return on invested capital has to be very, very rich. Right. Well, Thras started prior to the pandemic, and they started an immature market. Then the pandemic happened and accelerated everything, basically 10 years. It fast forwarded everything 10 years. Everyone's read the McKinsey report, et cetera, et cetera. So you have this massive secular tailwind because of this huge, pandemic, this huge moment in our history, accelerating e-commerce. And now all of a sudden, these assets that were purchased for very cheap, right, are accelerating at a rate that's making everybody really, really happy. Everyone's singing what I would consider the Lego movie theme, right? Everything is awesome. So everything's great. And really what you had happened going through the pandemic is that's when the acceleration of the aggregator or roll-up model started to scale out, and it grew from a handful to, as of today, we're close to 100 globally, right? With I believe 18 kind of being the top, and then I believe 25 having raised over $100 million. You got a lot of demand, and now you're squeezing the supply. So you go into 2021, balance sheets, P&Ls. So the cost of capital is still looking pretty good going into 21 because you're kind of coming off of that 2020 tailwind of COVID. People, the world isn't opened up yet. People are still shopping for consumer products. Side note, 2/3 of our economy is services, 1/3 is consumer products. In a normal economy, it flip-flopped during that time. That's germane here to a point I'll make in just a second. So the world starts to open up, and what happens? Well, people start to switch over towards services again versus consumer products. You see a massive slowdown start to happen in June, really is what happened, which I believe a recent report, which I won't disparage, it was a good report, but a recent report came out about aggregators and their buying mentality. Just so everyone is aware, it was from June. And that's exactly when after that report got a survey, everything changed and views started to change. And so now if you surveyed aggregators, they have a very different view than that report that came out in June, because that's when P&L started to get the cost of capital versus the return on invested capital, the spreads compressed. And when that happens, all the investors get worried. They get very nervous about what's happening, right? And so really kind of through the summer, you saw a slowdown in acquisitions, number one. Number two, you saw a lot of criticism when it came to assets, and it really started to flip the mentality of these aggregators in the way that they view the current asset base. Really, the idea I'd say in 2020 was, let me just buy cash flow, right? I don't really care about the product. We'll get into brands here in a minute. Let me just buy a product that's profitable. And then you start to go into a massive slowdown, and it really actually, it sensationalizes that compression, right? Because you're not a brand. People don't care. It just starts to sink even faster than if you say we're a brand. And so, to give that kind of backdrop to where we are today and the news that we read about the co-CEO stepping down at Thras, and, people have heard some rumblings about what's going on there. We've heard rumblings about other aggregators that are large, that are pausing acquisitions. A lot of it has to do with the fact that you went through something that accelerated everything. You're starting to normalize. Spreads are compressing because of supply chain issues, because of a lot of different added costs that weren't expected, right, from assets that were purchased earlier this year. Investors are getting a little worried and nervous about what's actually happening. And then also now everyone's just taking a step back because they grew so fast, right? And they realized that the most important part and the most important piece of this entire model, when you rip away the tailwind, right, you have to be an operator. Period. Mm-hmm. No questions asked. They all want to be J&J. They all want to be Unilever. They all want to be P&G. The reality is P&G wasn't a finance function first, operator second. They were an operator always, and still to this day. And they have a corporate finance team that is always looking for strategic roll-ups and acquisitions. Mm-hmm. But they're an operator. J&J, operator. Kimberly-Clark, operator. So that whole model, you have to be really, really good at operating. And so I think what they're realizing now is, okay, I've got Advent International, it's $200 million into my equity pool. I've got other real institutional investors. Goldman Sachs is not an investor, but they're a debt provider. And you got a lot, JP Morgan wrapped a lot of their debt, and was hoping to really take them IPO. So you got a lot of institutional hands involved. Well, I've been involved in private equity owned portfolio companies. And I'm telling you right now, private equity is very, very cutthroat and very sharky in the sense of grace doesn't really exist. If it's not working, then they immediately find something that will work. And I think what you're going to see here, just to keep things non-disparaging and very high level, I think what you're going to see at Thras over the next, and other aggregators potentially, you're just going to see a shift in regime. It happens a lot when you've got institutional investors involved and things aren't going the way you want it to go. When I was at that portfolio company, was a $500 million company. It was owned by Weston Presidio. I saw 3 CEOs in 3 years, three basically an executive team that just came in and out, not necessarily a revolving door. It was just always, if it's not performing, bring somebody else in who can actually perform. So that's a little bit, the public release, the public domain message was burnout. I don't necessarily believe that per se, just me giving my own opinion, not Global Wired's opinion, but I don't think it was necessarily burnout. I think it was institutional investors getting impatient about an IPO getting delayed. And you're going to see, I think, a lot of changes at Thras and other aggregators in the executive regime. You're going to see a professionalizing of a lot of these aggregators.
Okay, I think what you said about, for example, the biggest one, Thrasio. Let's just pick Thrasio out because it's the largest one. It makes a lot of sense because they are now in the position, I would say, very brave, because they need to lead the way. And others just now can watch and see, they do it like this. Okay, then maybe we can follow. It's like, obviously there is a plan behind it, but I mean, like, okay, if they get problems on this way, let's try another way, because it's obviously there is a problem. So and now Thrasio, obviously they have a lot of pressure on them, And I think it's really good for the industry to look at it, because you can learn so much. And out of the situation, what they do now, CEO is gone, who's going to replace him? Who is the good leader in now? Who's going to lead the company to the next level? This will be so impressive to watch. You can obviously learn so much out of it. So I think it's even maybe good for us all that this happened, because we can see and we can learn, and for them the same, because they can see out of the situation, do the best, and just move on with something else. What is working, because they have so much power in the back that they can actually, maybe other firms could not have taken it and we're already down, but they have so much power that they can really stay established and push through to the next level. Although learning by maybe by mistakes, or learning through doing, this is what I can pull out from there.
Yeah, I mean, it's in I actually spoke at BDSS, the virtual event back in March, about this particular topic, which was the canary in the coal mine. I mean, that's really what we're going through right now. And we're seeing the canary come out slowly, and we're about to see the canary come out and see how much damage was really done through this kind of first wave model. And really what's going to happen with that particular canary, because most of this debt funding, and it's mostly debt, is venture. It's risky. Tides come in and out in venture very, very quickly, but professional asset managers are watching this space very closely. Real, I would call professional financial sponsors, really, larger to lower middle market PE funds, strategic funds. I say even corporate strategics. They're watching this very closely, and they're very, very interested in exactly what you said, Omar. They're interested in the canary. Right. And in Thras's case, it's a little bit, if you remember this whole phrase back in the recession, but too big to fail. Right. It's a little bit of that at the moment. A lot of institutional hands are involved in that. It's a little bit of a too big to fail. So they're going to do what it's going to take to really try and make this model work. And look, roll-ups are difficult. There's a phrase in finance called roll up to blow up. And it's not just a joke. I mean, this is what happens. Like, you have a lot of people trying to do one model, and then all of a sudden, you have very few people actually being able to succeed. We have a research piece that's coming out probably in the next 2 weeks, and we pull on other sectors and markets that have done this type of model before to really allow the space to understand kind of, hey, let's really educate you, because the educators of this space and acquisitions are the aggregators, by the way. And so it's time to, it's time to educate the space and pull back the curtain. Let's see Oz for a second, right? And let's just kind of show the market exactly what it is that's going on based on examples of how this has worked in other markets. And so, yeah, I think that's a good view, Omar, of just kind of, the space is following Thras, and we should, and by the way, no one wants failure here. That's not good for us. It's not good for the space. Nobody wants it. I'm not rooting for failure. Nobody's rooting for it. But there is a thing called objective analysis, and we just should all be prepared of what's going to happen. But what's after that, when the professional money rolls in, we talk about it a lot. It sounds like an arrogant statement, but $9 billion being raised in finance is tiny. It's small, very small. And so when the professional money comes in, this whole market is going to look so different. But you need that analysis to educate the space. Hey, look, it's all good. Like, you've never been through this before. So we're going to coach you and walk you through exactly what's going to happen step by step. And just so you know, it's still and always will be a good time to be a seller and a service provider in the Amazon market. No questions asked.
Oh, Chris, definitely. Sorry, Melissa. It's like going in little by little, tasting and seeing what is going on. And if you burn your hand, just put the hand back. It's right. To keep it very simple.
You learn about pain, right?
So what I wanted to ask Melissa is for our listeners to explain a little bit. Maybe some want to know more about the accelerators and the aggregators. These are two different things. Maybe you can elaborate a little bit on these two different models, because some aggregators, they are accelerators and aggregators, but not all accelerators are aggregators. So would be great.
Yeah, no, I think maybe Chris could probably explain this even better than I could. So that's what I kind of am thinking. Maybe we should explain a little bit for the audience, what's the difference between an accelerator an accelerator and an aggregator. And how did even the term accelerator come about? Because that was sort of a natural process on its own. Can you tell us a little bit about that, Chris?
Yeah, I mean, the accelerator model has been around for a long time. If you've ever heard of like Techstars, or you've ever heard of like just the term incubator, that's more or less what an accelerator kind of really is. It's being able to identify, really it's startups. It's more kind of the startup company, or what I would call like page 2 brands, right? Page 1 is, I got to start this thing from scratch. Page 2, you typically already have the branding, you've got the product, you got the innovation, you got the patents, but you're terrible at marketing. And so, great example, InBev, which is, one of the largest food and beverage companies in the world. I drink a lot of their beer, and they actually have an incubator program. A good friend of mine runs a digital marketing firm, and he's one of their mentors for that particular incubator program. And it's very similar to an accelerator, right? Basically, you latch yourself onto, it's kind of like I'm driving a Honda Accord and I put jet fuel in it effectively, right? But the difference is the Honda Accord actually morphs into, a sports car one day, but I still take that jet fuel. So it's a lot of shared resources. So it feels a little similar to, say, an aggregator in the sense of what an aggregator is building. But typically an accelerator is already doing that to some degree, and you're just kind of coming along into their production line. That's more or less what an accelerator does. And it's also a difference in business model. And I'll be frank, I don't really know what 70 to 80% of the aggregators end game actually is, because they don't really talk about it. Some of it is they don't know. Some of it is they don't want to talk about it because it's in their pitch decks and they believe it's proprietary. Some of them talk very clearly about going IPO, maybe wrapping and, all the brands or divesting brands, et cetera. Typically in an accelerator model, it's you're growing it to a point and you're divesting it, because you basically built brand. You built a brand, you're not building a product, right? And so you sell it off to a corporate strategic as a bolt-on, you sell it off to a private equity fund, et cetera, et cetera. That's usually the model inside of like a true accelerator. So Pattern is a great example.
I think that's already
helpful.
very good explained, very well explained. And just another question as well. What do you think, who's going to win the day?
Amazon sellers who grow a brand all day
So
long.
accelerators or aggregators?
Between the two, I think you're going to see, it's interesting. Accelerators tend to have a little bit of a less risky profile. So again, it kind of goes back to risk analysis. I think aggregators have exposed themselves through very expensive debt. Some of these aggregators are taking on debt that's more expensive than my stinking American Express card. It's bad. Like, it's bad.
It's so high.
Venture debt is not cheap. It's private debt. It's private placement of debt and debt funding. It's not prime or LIBOR. This isn't like you and I trying to get a mortgage. This is like, hey, I kind of believe in you, but I'm going to make sure I make a lot of money here in the process.
So I have a quick question, if you don't mind, Omar. Omar,
Yes.
you mentioned that, this can, for some of these companies, the aggregators especially, it's going to be like, testing things out. And if you get burned, you pull your hand back. I think that the leaders are going to kind of have that situation. They have a handle on things. They're quick to pivot. What do you think, Chris, about, taking that into consideration? Do you think some of these others who are already following the lead and taking out, big debts to follow Thrasio's lead or some of the other leaders in the space, do you think them trying to follow the lead of Thrasio in some of these pivots and changes may work against them because it may not necessarily fit their business? They're just sort of trying to keep up.
Yeah, look, when you're majority debt, it's really difficult to turn. Really, you can look at it in terms of handcuffs. So unless you've got a really, really great relationship with a majority debt provider, then you're able to probably, kind of move and wiggle a little bit better. Equity is actually what allows you to go and do all kinds of things from a creative latitude perspective. You can pivot and you can move. There's a aggregator. They were actually at BDSS. They raised $500 million of equity, no debt. They can do whatever they want, and they can buy whatever they want. They're not handcuffed to a term sheet. So a lot of this debt comes with a lot of contingencies. Okay, you can buy businesses, but you can only pay a 4 multiple. You can only buy businesses in these verticals. You know, it comes with a lot of terms, right? But when you have equity, that's when you can typically pivot. I think if it's something large, Melissa, like if it's a really big, like, oh, wow, we just got a preview of where we're headed. Yeah, it's like a cruise ship. I mean, you got to go back to your investor committee and you got to talk to them and to your debt providers, and everybody has to sign off on it. When you're equity, you look at it and you go, we don't want to do that. Let's move as fast as possible.
Right.
So it's a little bit different, I'd say.
Yeah.
Okay, understand. Yeah, so I think these were the main questions that we had for you today.
Sweet.
It's it's a lot of information, I think, for everyone. And yeah, let's keep it there, and at some point pick the conversation up again when we are further into the whole space, the aggregator space. You know, further down the line, I think there will be a lot of changes within the next 10, 18 months.
Well, there's $2.4 trillion of cash on a consumer balance sheets right now. And you're about to see a Christmas. If anybody has inventory, they better raise their prices. If they don't, they're stupid. So raise your prices, please. I know that sounds really weird, but do it. You have inventory. You're going to see a pretty strong Christmas. And I think Q1, really March, kind of post-March, things are about to get a little rocky. And I think that's when you're going to start to see spreads compress again. I just don't know if investors are going to be willing to kind of go through that ride one more time that they're going through right now. So we'll see. You're right, Omar. We should keep up with all of this. It's in real time.
Chris, what would you say for sellers, like in terms of planning their Q1, right? A lot of people, they'll have a big Q4, they'll take a deep breath, and then they'll jump in strong for Q1, source a couple new products. Given your advice just now and what you see coming up, what would be, continued advice for what they would maybe normally do in Q1, maybe they shouldn't do this time?
Yeah, I mean, look, I think supply chain issues are going to start to suppress, which is good. I think we're going to start to kind of come on the backside of the backside of Chinese New Year. We're going to start feeling like relief. And your brother speaks about this all the time. All this stuff. But we're going to start feeling the relief. Jamie Dimon, who has to say this from JP Morgan, said that by next year, all these supply chain issues are going to go away. I don't think that's true. I think it's going to start going down. We just talked to a guy the other day who is actually buying container futures. Seriously, like he's buying a container contract for the future for I think March or February at this point, and it's $8,000. Well, they're pricing it there because they're already, the container companies, the forwarding companies are already expecting prices in Q1 to go down and significantly. So that's good news, right? So how to prepare? I mean, look, I'm going to go really high level, but you got to start thinking about yourself seriously and no longer as a product, and you got to start building a brand. Like if you don't stop and start that process now, you're just going to get left behind. You're going to slowly kind of create something that is not a great asset. It's not very sellable. You got to have something that creates sustainability, and at a very, very high level, you always start with brand, right? And so, from a mechanics perspective, so that's more of like a high level kind of qualitative perspective, but from like a mechanics perspective, I mean, look, it's going to get tough. It's going to get tough to compete. The competitive pressure on the marketplace is going to get more and more difficult. Going into new markets, start preparing for that if you haven't considered that. Can you rotate? This is why brand is important, because brand allows you to rotate off Amazon and become something better and bigger than just an Amazon micro brand. Gosh, I could probably talk for days about this, but at a very, very, very high level, just expect a slowdown next year, and start to get involved in whatever it is, whether it's masterminds, going to conferences, seriously, like listening to other people and how they're already starting to prepare themselves, like really successful people. And get anybody listening that's heavily immersed inside the Amazon community, start going to direct to consumer conferences and branding conferences. Like start really educating yourself in, okay, like I need to really learn how to do this whole branding thing. It's very, very important long-term. So
great,
high level stuff.
Excellent, thank you.
Melissa, what do you think about the whole situation? I mean, in your business, where you have been before, How did you feel the whole situation? What was going on? What do you think about it?
It's been a crazy ride, really, to watch this, evolution of like the aggregators, and how at first, there was sort of a discord between the sellers and the aggregators. Like, is this a threat to me and my business and the way that we're going to do things? Are we always going to be competing against the big dogs? And coming at that from the empoweree stance before trying to, really stand up for the sellers and have a louder voice and stuff with more leverage. That was a very big thing on our minds. But we formed some good relationships at Empowery with aggregators, and Eva as well has some good relationships with aggregators. And since it sort of started evolving, then you could kind of see like, okay, now there's a space here for aggregators. There's, the difference between brokers, aggregators, like investment, finance type cells and stuff like that. So there became a space for that, where I think before it was sort of a threat. And at a certain point, then people started to say, well, maybe my business wouldn't be one that got picked up by a proper broker, or, maybe it wouldn't normally be sellable, but this aggregator sees potential. So this is a good thing for me. So it opened some doors for sellers. That's always a good thing. And now kind of seeing this evolution where it just boomed up. It was like the mortgage boom, like everybody's buying houses, and then all of a sudden, there's no more customers. And it feels like that's sort of what happened with the aggregators, like this huge leap in getting funding and all of these new aggregators coming into the space. And then now we kind of see the 2008 of aggregators, it feels like, where things are sort of slowing down, and we're kind of seeing some of the impact of this huge gold rush.
Yeah.
So it's very interesting to watch. And I think, the competition between the aggregators, that was a very positive thing, because as long as there's competition between the service providers, there's always going to be a win for sellers, as long as they're well informed. Sure. Now, even given this is a natural process, with the aggregators, it's getting sifted. They're sifting the wheat from the chaff really right now, where the really good ones who are also operators, like Chris was saying, they are rising to the top, and the ones who are not able to sustain anything besides raising capital, they are not going to make it. And so that's also good for the sellers. It's again, it's a natural process, and the best will outlast. And so then the best is what will be available to the sellers.
That's a great way of putting it. That's
great.
That is an institutionalizing of the space wrapped up in what happens when you professionalize a space. That's exactly what happens.
Yeah.
That's wonderful. Yeah.
Great to wrap this all up. Really good. Thank you so much, Chris, for being here.
Thank you.
We thank you, Melissa, as well. And
yes.
Let's hope Hi gets over this very quickly.
Yes.
And
yes.
It's
I hope so.
Yeah, shout outs to Hi.
But it was such a pleasure to join you guys in his stead.
Yeah, seriously, it was a wonderful surprise. I love it.
Yes, it was a good surprise.